Hi, Jeremy Harper here, mortgage broker. Today I want to talk about 40-year mortgage. This is a product that's relatively new into the market. It's really aimed at the younger borrower or first-time buyer that's trying to get that first mortgage that are restricted with their serviceability when it gets to a 30-year mortgage. So this is in response to obviously higher property prices, higher average mortgages, and high interest rates, which is really putting a handbrake on people's borrowing capacities at a 30-year mark. So I just want to unpack how that would look, and what are some of the pros and cons we need to think about if you're trying to do a 40-year mortgage. So again, it's a very niche product in terms of the target market for this product. The banks are looking to service younger clients, potentially getting that first mortgage, and they're allowing that 40-year period as opposed to your traditional 30-year mortgage to stretch out the borrowing capacity and also reduce the monthly repayments. So we'll go unpack that in a second. A couple of things to think about is really we are considering what is, number one, the monthly outgoing for that period of time. So yes, it's a 30 or a 40-year mortgage, but the reality is an average product or mortgage now, the life of the mortgage is around 3 years. So what this could be is a short-term solution, get yourself into a 40-year mortgage, and then in 3 years' time, when your income has increased or there's been other changes to your household, you can then refinance that back into a shorter loan term, or even just go back to that lender and pay that back instead of over the 40 years, increase that monthly repayment so we can accelerate the repayment to come off and repay over that original 30-year mortgage time. Because the recommendation is always get into that first property, build some repayment history, and then once you've got that comfort, which normally I find with borrowers after a year or two, you can start to put either more money into your offset account or make additional repayments onto that home loan. So an example I've got here, which I'll put the details up, it's a $600,000 home loan, interest rate's 5.75. So the monthly repayment on a 30-year mortgage is $3,501. Now, if you were to go into a 40-year mortgage, that reduces the monthly repayment to $3,197. So it's a $304 saving. So number one, you get the additional cash flow up front at that period of your life. Maybe you've got some other debts you're trying to clear out. Maybe you've got a HEX debt that you want to get on top of over those next couple of years, or there's a car loan, or maybe there's a credit card that you want to sort of also pay down as part of this. And you think by having a lower repayment, remember the interest rate on that mortgage is typically lower than unsecured debts, number one. But then also when it comes to serviceability, obviously we know the bank's going to stress test that loan at not 5.75 but 8.75, so an additional 3% on that mortgage. So you get the upfront benefit there, better cash flow. But what does that mean? So if we fast forward 10 years and we look at the total interest expense, so because of that increased repayment under the 30-year mortgage, we now have a saving at that 10-year mark of $12,674 in interest. So you're starting to see that difference between the two, how the 40-year mortgage at 10 years in starting to cost you a bit more in terms of interest. But the big difference is at the end of the loan term. So if you were to run that out for the full 40 years versus the full 30 years and not make any additional repayments, not have any money in the offset account or redraw, there'll be an interest difference of $274,199. So very significant difference if you'll let that run the course of the first 40 years. So my recommendation would be, if this is something you're looking at, yes, it's over 40 years, but this is something that we need to think about in terms of your short-term goals. How do we get out of that? Or how do we start to make additional repayments into the future? So like anything, we need to understand your goals and work out if this is suitable maybe for you today, and then what's suitable for you in 3 or 4 years' time. But obviously a big takeaway from this video is not, if you are taking out a 4-year mortgage, do not let that run for the full course. We want to make sure we're making additional repayments, so we're not paying an additional $274,000 on that same product if it was over 30 years. Any questions, please let us know. Thank you.